Hello, this is Kelly Fasterling, financial advisor, real estate investor, and realtor. Today, our topic is around life insurance and creation of a foundational asset that can then be used in your future investing strategy. And I'll give you some examples of how that could work. Most people, frankly, think of life insurance as a risk mitigation strategy. Bottom line, if something happens to them, they want to make sure that their family is okay. If you have some younger kids and you're concerned about replacing your income should something happen, or maybe you're a little more advanced, but you're still paying on a mortgage and you want your mortgage covered, should you pass, or you want a strategy to get the kids through college if something happens to you, then you look to life insurance as that benefit. Now, you're used to three different kinds of life insurance. There's term insurance, that's basically renting insurance. You're paying for the death benefit in a certain window of time, in 5, 10, 20, 30 years of time. And then when that time expires, you need to re-up the rent of that insurance. And typically in the industry, that becomes prohibitively expensive, so that 95% of the people that pay into term life insurance never die in that window and they don't get the benefit. And then when they go to re-up it, it gets so expensive they choose not to. The kids are grown, the mortgage may be paid off, they're in a different position. So that's the term insurance. The other two kinds are called permanent insurance. It's whole life and indexed universal life. Those give you a cash value. So now you get some benefit, long-term benefit for the value that you put into it, the premium that you put into it, and that can grow. Okay. So if you look at the different vehicles, that whole life vehicle is a very predictable, safe vehicle, where the indexed universal life, also very safe, but has more of a potential growth strategy. So why would you get life insurance, term, whole life, indexed universal life, if you don't need the death benefit? If you're not, maybe you're single, kids are grown, mortgage is paid, you really don't have anyone dependent on your income, or you're retired and you don't have that income. Life insurance, if you look at it in a different light, can be a very, very interesting investment vehicle if it's designed right, structured right, used right, and with the right company. It can become the most amazing financial foundational asset in your portfolio. Now, I mentioned that there are 7 benefits associated with life insurance as a foundational asset. We'll walk through them. One of them we covered in our last segment when we were talking a bit about long-term care. And we were talking about the potential of life insurance as a component of your living benefit strategy. What do I mean by that? If you invest in life insurance, not only do you get that death benefit, which can be significant, but you also get a living benefit. You get the opportunity in many policies to pull against that death benefit while you're still alive. If you have a terminal, a chronic, or a critical illness, you can tap into 25%, 50%, 75% of that death benefit while you're still alive. That really helps to preserve some of your assets, maybe for your spouse, should you get into a situation where you need a lot of medical care prior to one of the two of you passing. So that's a second benefit that's available. Well, if you're much younger and you're in your 20s or 30s or 40s or 50s, frankly, and you're looking for a foundational asset for transfer of wealth to heirs, or a foundational asset for your investing strategy, let's focus the rest of this session on that concept. Okay? So again, structured, funded, used right with the right company, then that's what we're talking about here. So let's talk about the evaluation of assets when we're looking to determine where and how to invest. Stock market's up and down, actually a little bit down right now. So in that environment, safety is key. We want an asset that's just 100% safe where we don't take those downside losses. If you could be in an asset that you put your money in, and when the market drops, you just stay level and maybe don't earn anything, but you stay level and don't take that 10, 20, 50% loss. It's a game changer in how your portfolio is sustainable. So safety is one of those components. Tax efficiency is another real important piece. When you look at the drag of taxation on a portfolio, on actual value. Now, for instance, you have a traditional IRA, you've got 100,000 in it. How much of that 100,000 is owned by the IRS because you're going to have to pay taxes on it? That's a big consideration. But also the lost opportunity costs on taxes. So you need to kind of think through the taxation ramifications. Life insurance, again, used properly, can be a foundational asset that's treated just like a Roth. Now, many folks are in an income bracket or not in a private job where they're unable to really contribute into a Roth IRA. And so they're playing that tax game. In life insurance, you can move into that investment vehicle like a Roth without the income restrictions of a cap on your income, or without all of the other restrictions of you have to be 59 and a half to access it, or you have to take required minimum distributions when you're 73, or there's a cap to how much you can put in. It becomes a vehicle to have the best tax efficiency without all those limitations. Rate of return. That's another key component of a foundational asset. You want an asset that earns a solid rate of return. Now, we used to be comfortable with the banking system and putting our money in the bank to keep safety, but we never got a rate of return there that was anything acceptable for growth. In a proper baseline insurance product, those rates of return can be equivalent to what you would expect to see in the market. So now they become a good candidate for some long-term investing. Liquidity. Liquidity in an investment vehicle is really key in my mind to creation of a multiplication strategy on your assets. Let me talk about that just a little bit. When you invest in a traditional or Roth IRA, you're not liquid in those assets. Until you hit 59 and a half, you really can't use them, touch them, do anything with them. What if you're early in your investing strategy and you're prepping to buy your first home? If you had a vehicle that allowed you to save, but then use that to go buy a home, or save and use that to go buy a rental property, something that's going to create some income for you, it becomes a very interesting strategy to use that money, save it, but then be able to employ that money in a second spot. And I'll give you a real story around that before we're done here. So liquidity becomes a very interesting option with life insurance as a vehicle. Now, it's life insurance. Everyone thinks of life insurance as being expensive. And there's no doubt there's a cost to it. You're paying for that death benefit. If you're putting in this much, but your death benefit is up here, there's a cost to that. Many of the policies, though, are either owned by the policy holders and they have a dividend strategy, or they have a bonus strategy on them. And so, again, depending on your age, There are multiple ways to get the cost of insurance back to you. If you're starting when you're young enough, I ran an illustration for a 27-year-old. Within 3 years, his cost of insurance up to that point and ongoing was 100% covered inside the policy. Now, if you're a little older and you're really engaging it a little bit later in life, the cost of insurance continues to go up year by year inside the policy. Not the premium, but the cost of insurance inside the policy. But there are also two other ways that cost is returned to you. And so even though it's an asset that does carry a cost, those costs can be fully recovered in various ways. So as an asset, it becomes a very amazing foundational strategy for investing period, but then investing twice with the same funds. So let's chat about that twice with the same funds. I'm a very active real estate investor. When I learned about this possibility of putting my money in an asset that is liquid so that when I'm ready to buy, I have it, that is safe and doesn't go backwards, that the expenses are covered in it, it gets a good rate of return and it's tax efficient. When I learned about this baseline asset, and then I learned how I could then use this asset for my real estate investing strategy. Let me tell you what I've done there. So I started with the asset itself and started to put my funds into the asset, saving up for my next house. When I got enough to buy a house, I would borrow from that asset. Okay, so the insurance company still counts that money as being there. They're still paying me that interest rate on that money being there. I loan it to myself and I go buy a house. So now that money is getting paid inside the policy and it's getting paid inside my rental real estate. I'm getting the appreciation value, I'm getting the cash flow on it, I'm getting the depreciation on it. So now that same dollar is earning for me 2 times. So with that strategy, I was able to take the original cash that I had accumulated to buy one house and then have the growth on this house and the cash flow on this house go back into my policy and then get me to the point that either the appreciation on the house was enough to buy a second, or the growth on my portfolio here was enough money to buy a second. So how does that really work? So let's walk through that. So if you're sitting in an asset, and let's just say it's earning 10% over here in the life insurance policy, and then you borrow the money out. Well, there's a cost to that. So you're going to pay 5% back to the life insurance company for borrowing that money. At the same time, you deploy it over in your real estate. Okay, so you're paying 5% on that money, but it's earning 10%. So even though the money's no longer there, you're still getting a positive arbitrage of 5% on it. But at the same time, it's deployed in your real estate and you're getting whatever your real estate nets you. So I started this strategy and started it fairly late in life in terms of understanding it and deploying it in my strategy. But it's been an amazing savings vehicle that's fully safe, earns a good return, great tax efficiency, expenses are covered, and it's liquid. Plus, I get the death benefit and the living benefits on it as well. Now, I have many clients now that are retiring, and because legislatively the traditional IRA came out long before the Roth IRA, many of my clients have the bulk of their assets sitting in a traditional IRA. So with Bob and Jane, I'm able to look at their asset base that's predominantly traditional IRA. And if that, let's just say they have $1 million in there. And if they're earning an average 7%, it's going to double about every 10 years. And so that $1 million when they're 60 could be 2 million when they're 70, could be 4 million when they're 80. Do they want to pay tax on the million sooner, the 2 million or the 4 million later, or as a transfer of assets to their heirs long term? Do they want it to transfer taxable? So as we look at Bob and Jane's portfolio and review what's important to them, letting go of the IRS as a partner in their traditional IRA becomes important to many of my clients. And so we work through how to structure that to get it shifted into an asset that's safe, gets a good return, liquid, very tax efficient, that the expenses get covered. We shift basically their portfolio from their right pocket to their left pocket to put them into a position where they're paying taxes now, and especially because taxes are on sale right now. When Trump passed that 2018 tax bill, it rolled back the tax percentages for another couple of years up to 2026. And so you have to evaluate whether you think taxes are going up, going down, or staying the same, and how you want to manage your tax burden on your entire estate. So that's a brief introduction to considering a life insurance vehicle, a permanent life insurance vehicle, as a strategy for multiplication of your assets, but investing in a very safe, secure way. So that's it for today, and I look forward to our next session. You take care.